regardless of where you live in the United States of America, homeownership is either not available or it's not affordable. And in many markets, it's both. However, I have learned after 20 years of working in mortgage and real estate that it is available and it is affordable if you're working with the right team. Unfortunately, too few mortgage loan originators, too few real estate agents, and more specifically, the clients they serve, they don't look at things from the right angle. They're not using the right point of view. They're just not customizing things where they can find a way to yes. This whole episode is going to be based on 5 things you can do today to make homeownership more available and more affordable. Check this out. Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and with me from the TLOP team, I got my right-hand man. He is Marketing Mike, a.k.a. Mikey, Rocky, Vinny, and our producer extraordinaire, we call her Special K, you call her Karina Mojica. What's going on, guys?
What's happening?
Yeah, what's happening? How are y'all? It's been a hot minute since we've been together.
It has, yeah. Yeah, we had some good stuff over at FAMP, right?
Dude, we had some great guests. Some absolute great guests. We had Mike, we had Tom, we have Orlando.
Yep.
Like, it's been an incredible couple weeks here at TLOP. I'm pretty pumped up. We're going to be talking about the Caribbean Takeover that we're doing this summer. Probably the coolest mortgage event ever. Like, let me ask you a question. Well, Karina, you're too young. Okay, and Mike, you've been around the block, but you haven't been necessarily around the block in the mortgage industry. Let me just tell you instead of ask you.
Yeah.
My 20 years in this industry, I've never seen an event like the one we're hosting. Like, you're getting on a cruise ship with 100 plus other mortgage professionals heading to the Bahamas, where for the first time, it's not about the speakers on stage. It's about the people who are attending.
Yeah.
The networking events, the masterminding sessions, the breakout sessions. We're going to do an absolute massive, party at the end of it. We're doing a sunset sail away networking mixer at the beginning of it. And we're going to do a private beach bash with full access to me, the TLOP team, all of our coaches. We have company owners coming, divisionals coming, as well as rookie originators who recently got their license, but they're coaching with TLOP. So we invited them to come along. I'm pumped up, man.
I'm fired up. I can't wait for this.
Yeah. And Karina, you're coming, right?
Yes, of course.
Oh, you have to, because we're going to be podcasting.
TLOP crew.
We're going to be podcasting
live
from the event.
From Oasis?
Nassau?
Not Oasis. What's the boat again? Utopia.
It's Utopia of the Seas. It's Royal Caribbean. And the best part about it, and this was important to me.
That's the best boat.
TLOP's not looking to make money on this.
Right.
We're looking to make it accessible, affordable. Like, we want to invite people to have access, to be in the room where it happens, to be a part of the Cool Kid Club.
Yep.
So it's extremely affordable.
Sure is.
I know we're going to get a lot of people who come in from Florida, a lot of people come in from Georgia, South Carolina, Alabama, because those are all very drivable. But I was telling my friends Josh and Amanda and Eric in Alaska, they're still going to come. I know Josh and Amanda are going to come. So for them, the most expensive part won't even be the cruise.
Yeah.
It's going to be the flight. Getting to Orlando, Florida that Sunday before we get on the boat and then having to pay for a hotel room.
I mean, to eat for the whole week alone. You know what I mean? Like, all of the meals you're going to have, and then the value you're going to get out of the coaches being there and the breakout sessions and the party. It pays for itself, period. You're not even buying a ticket, really.
Correct. I mean, think about it. We're going to have an event Monday night. That means probably alcohol is provided.
Yeah.
We're going to have a private VIP beach bash.
Right.
More than likely, alcohol is provided. We're going to have I'm pushing for a Caribbean cowboy theme. It's not guaranteed.
You had my vote. I'm in. Yeah, Caribbean cowboy, I would love.
But that Bon Voyage bash,
yeah,
more than likely alcohol is included.
Yeah.
Plus, when you're on a cruise, all of your meals are provided. So it's like literally get on the boat and then network.
Yeah.
Yeah. We need to somehow loop in I'm on a boat.
Yes. I'll do that in the next promo.
Will you?
Yeah.
Yeah,
if it's licensed through Meta, we'll see.
Yeah. But anyhow, and then obviously we were at FAMP's Central Florida chapter event a week ago, where we got to do those awesome podcast interviews, which was super exciting.
Yeah.
But today, 100% is a Realtor success series. Think of this as a lunch and learn that I just taught to 40 plus originators. All these originators work with our coaching students.
Yep.
So it's something that we do if you come and coach with us, if you're part of our coaching community, is we do a monthly call specifically for your real estate agents.
Yep.
And I do it because as an originator, as a branch manager, it was important that we always had events to invite realtors to, right? And events are a way to give back. It's also a way to stay top of mind. So I know a lot of our loan officers, a lot of our branch managers are a little bit shy. They don't want to do events. They don't know how to do them. So we do a virtual event once a month. Well, last month I coached these 40 realtors, and really I coached the loan officers too, that there are 5 things that you can be doing right now to make homeownership A, more attractive, and B, more affordable. So like sometimes I say attractive, I call it available, right? But it's like, how do I make homeownership attractive? How do I make homeownership available? How do I make it affordable? And if you just go surface level, you're not going to be able to. Facts. Right. You're not if you're just looking at today's interest rate.
And now this realtor series, like you're saying, this is what you're telling the realtors.
Yes. Yeah. Yeah. But look, I coach the LOs to coach their realtors.
Right.
But sometimes, not sometimes, once a month, we tell the LOs, we're going to do an event. All you have to do is invite, text, email, call your realtors, invite them on, and I or one of my friends in the industry will come on and coach your realtors on what they need to be doing in order to generate more leads, convert more leads, sell more homes, make more money.
I love it.
Like what's currently working. Like you'll end up doing a realtor success series where you'll teach realtors how to either leverage Meta, how to leverage AI, how to leverage websites, how to generate their own leads, because you have half a dozen clients at real estate agencies. You generate leads as Mike Siciliano for realtors.
Yeah.
So why shouldn't we have you come on and teach that?
Let's go. Sign me up.
Yeah, we're going to sign you up. This is me like kind of prepping you. This is something you're going to do.
Let's go.
So no, I just taught this class, but I now want to bring this class to the podcast. So that way, if you're a homeowner or a home buyer tuning in, you're going to get the knowledge.
Yes.
If you're a real estate agent, you're going to get the knowledge. If you're a loan officer, you're getting all the same knowledge. Then it's going to be, what are you going to do with this knowledge? If you're an LO, would you turn this into your own social content? Would you go teach this as your own lunch and learn? If you are a realtor, will you use these strategies to help make homeownership more attractive, to get more people to call you, to get more people to want to have you go show them real estate, because you were able to show them, hey, look, surface level, you're right, there isn't enough inventory. Surface level, homeownership isn't affordable. But here are 5 strategies that are proven that we could go create more inventory, or we could go make homeownership more affordable, and here's how. So that's going to be today's episode.
Cool.
Yeah,
let's get into it.
Before we get into it,
yes.
Karina, we probably should pay some bills, right? Karina does not work for free, y'all. She actually anticipates and expects a paycheck. So we use our sponsor money to pay for the services of our producer extraordinaire. If you want to be a sponsor of this show, I just talked to my friends over at Revolution Mortgage. They're interested. We already have lower mortgage interested. I'd love to see Redder, or I'd love to see Class Val, or some of our friends want to step up to the plate and go next level. Reach out to me. Dustin Owen on LinkedIn. Email is do@tloponline.com. But we do have to take a quick pause so we can hear from today's show sponsor. Check this out. The Gathering by Housing Wire is coming up in Austin this April from the 27th through the 30th. And after missing last year and dealing with that FOMO, I am already registered. I want to make sure that this is an event that y'all have on your radar. I remember my first time attending the Gathering. That year, the event was held in Arizona, and I was blown away. It was the first time I went to an event where the who's who of both mortgage and real estate were attending the same conference. It's been 2 years since I was last at the Gathering, and I'm still working with and collaborating with some of the people I met while attending this once-a-year event. Some of these people have now become friends as well as clients. I hear from you all the time about how you want to step up your game, run in bigger circles, and have the inside track on what is actually happening in the real estate and mortgage industries. Well, this event will allow you to check all of those boxes plus so much more. So go ahead and get registered today. Come hang out with me in Austin. The website to get started is housingwire.com/events and use my code TLOP10 for 10% off. So again, housingwire.com/events and use my code TLOP10. That's TLOP10. And at checkout, you'll get 10% off. I look forward to seeing you at this year's Gathering. All right, so we're back now. We are back. I'm curious, where do y'all want me to start first? Do you want me to start on the affordability side or the availability side of homeownership.
Well, what's the biggest pain point for buyers right now? You know what I mean?
Right now,
I think it's affordability.
It's affordability. Two things. I ain't got enough money for down payment and closing costs.
Yeah.
I can't afford the payment.
Right.
Right. Those are the two things.
Start there.
And typically the easy place to start when it comes to down payment is there are plenty of state-sponsored down payment assistance programs.
Mm-hmm.
There's even some non-state sponsored, right? Like companies like Click and Close.
Mm-hmm.
Click and Close, I know, has a product that loan originators leverage for down payment assistance.
Okay.
Ooh, our partner Hoper.
Yeah.
Like the reason for the Hoper loan is to make homeownership more attractive and more affordable when a homeowner or a home buyer. So Hoper works with both refinances and purchases. You can partner with Hoper and they have ways to give tax credits. They have ways to give money to help make homeownership more affordable to both homeowners and home buyers. Like all of that exists, right? We have state down payment assistance. We have non-state, which would like be Click and Close or something similar to that.
Yeah.
And we have companies like Hoper out there that they're doing their part to make homeownership more affordable. By the way, if you're not leveraging Hoper and you don't know what Hoper is, look it up. Reach out to our guy, Michael Pareto. You can find him on LinkedIn and just learn about his program and his product. The minute I learned about it, like I literally referred it to 3 of my divisional sales leader clients or even my friends in the industry saying, look, you and your loan officers need to know about this.
Yeah.
Okay, so those are some of the more traditional ways that I think most loan officers know how to make homeownership more affordable. But do realtors know that? Do realtors know these strategies that we're going to talk about? So here's the first one that I want to share with everyone. And this is on the affordability side. And I'm going to start with like, let's think like more first-time home buyers.
Mm-hmm.
And then I'm going to flip the script and then we're going to talk more about retirees.
Cool.
Because retirees actually are having an affordability issue.
Yeah.
So let's talk about both.
Reverse mortgage.
Well, you know what? Don't call it a reverse mortgage.
Sorry, spoiler alert.
Spoiler alert. No. Yes, I'm going to talk about reverse mortgages.
All good, yeah.
Yeah, I'm going to talk about it.
My bad.
But I'm not going to let you call it a reverse mortgage.
Okay, cool. Yeah, yeah. It's a terrible name.
Yeah, no, but it's so I taught these realtors how to leverage seller credits.
Mm-hmm.
For some LOs, they're like, oh, that's pretty basic, Dio. You're right, it is basic.
Yeah.
However, your real estate agents don't know this. And more specifically, they don't know how to market it. So what I showed them in this masterclass, which we call Realtor Success Series, is I gave an example. You could have a home listed for $400,000 and in today's market, except for like in Columbus, Ohio, Chicago, Illinois, Boston, Massachusetts,
right.
Like there's certain markets where it's still pretty much a seller's market.
Yeah.
The rest of the country is a bit of a buyer's market. So homes listed for 400, you may be able to get this thing for 380, maybe even 375. But at 380 or 375, sure, the home buyer may save $100 to $150 a month, but they still got to come up with down payment and closing costs. Right? They're still having to come up with somewhere between $17,000 to $20,000 for down payment plus an extra 10 or 12 grand in closing costs.
Yeah.
And the rate's the rate that they're going to get. Whatever the market rate is, whether it's 6.25 or 6.5, that's what they're getting.
Right.
Okay. What if they bought the home for $400,000, but they asked the seller to give them a $20,000 closing cost credit? Now, in order to do that, depending on the type of financing, you have to be careful of maximum seller contributions towards closing costs, right? A conventional loan may only allow you to do $12,000, where an FHA loan on that sales price will allow you to go to $24,000, all depending on what the maximum seller contributions towards closing costs are. But in this case, maybe the person was going to put down 10%.
Yeah.
So either put down 10% on 380 or put down 10% on 400. It's a difference of $2,000 between the two. So let's say they bought the home for 400 and they put down 40 grand, and they had that 40 grand because maybe some was a gift from mom and dad, some was a loan from a 401k, or maybe it was a loan from a 401k plus they had some money saved. Whatever the case may be, they were able to come up with 10% down, and they were doing a conventional loan. So instead of buying the home for 380, they bought the home for 400, but they're buying the home for 400, and the seller's going to give them $20,000 to go towards their closing cost. Well, they spend 10 of that 20 to cover just their closing costs. So now, instead of them originally having to put out of pocket roughly 48 grand, it would have been 38 grand for down payment, 10 grand for closing costs. Now all they're coming out of pocket with is 40 grand. That keeps $8,000 on the sideline. So just imagine, Karina, you're a first-time home buyer. You and your spouse or significant other are buying your first home. Would you feel more comfortable having $8,000 left over in your savings account, or having that $8,000 sitting in your home's equity? Which helps you sleep better at night? Give me an honest answer. Don't think too hard.
Probably myself and my
Yes.
All
Yeah,
day.
having that $8,000, man, when life throws you a curveball. Let's say you were like, oh, honey, this came up, my car broke down, I had to buy new tires, AC broke. We're just short about $200 or $300 this month on our budget.
Mm-hmm.
When you have $8,000 in a savings account, it's easy to go and take $2,000 out.
If you're short on reserves too, though, could that help?
What do you mean short on reserves?
Like if you're short on reserves in your account, you know how you need. I'm not an LO, but
No.
You know what I'm saying? Like because
yes.
they're looking at DTI and they're looking
Yes.
at reserves.
Look at you
Can that
go.
go towards the reserves too?
Yeah, well, whichever way you
because
look
that's
at
your
it,
money.
It's reserve
Yeah.
assets. And what Mike's getting at is certain loan programs are more favorable when borrowers have money left over. We call
Right.
those reserve assets.
Yeah.
And some loan programs require you to have reserve assets, right? But I'm just thinking, just from a pure, am I comfortable paying this? Am I comfortable? Yeah, you sleep better at night having that $8,000. So what we did is we had this home buyer still put 10% down, but they're putting 10% down on $400 and not $380. We then used a seller credit to cover all their closing costs. So now out of pocket, it's only $40,000, not $48,000. So they're keeping $8,000 in the bank. Helps them sleep better at night. But we still have another $10,000 left over. Well, that $10,000 that we have left over, here's what I'm going to do. When you're only putting 10% down, you have to pay mortgage insurance. What some people don't understand is mortgage insurance does not have to be paid monthly. You can pay all up front. So why not have the buyer pay all the mortgage insurance up front, but use a seller credit? Now, where they would have been paying $125 a month in terms of MI, mortgage insurance, they're now paying $0 a month in mortgage insurance. So I helped them keep $8,000 in the bank, and their monthly payment has no mortgage insurance.
Solid.
Now, the last thing I can do, because I have more money left over, I got $20,000 from the seller. I only needed 10 for closing costs. I used some money, maybe a few grand, to pay out or buy out the mortgage insurance. Now the rest of the money, I'm going to use to buy down their interest rate. So instead of them financing based on a $380 purchase price, putting 10% down, their rate would have been, let's say, 6.5%. I now have them putting 10% down on $400, and their rate's 5.5%. Now all of a sudden, their monthly payment's cheaper by $200 a month.
Yeah.
So they're saving $200 a month in principal and interest, $125 a month because they don't have mortgage insurance, and they have $8,000 left over in the bank account. By the way, the home was worth $405,000 the whole time, right? The seller listed it for $400. They're willing to unload it for $380, whether it was $380 with no concessions or $400 with $20,000 in concessions. Either way, it was going to be worth $405 because the home is worth what the home is worth due to a cost analysis comparison valuation method. So the buyer still is getting a $400,000 home for $400,000. The difference is one has them paying more and having less money left over.
Right.
One of them has them paying less in terms of sales price, but their monthly payment is more.
Yeah, the monthly payment's more.
The monthly payment is more. The sales price was lower, and their cash out of pocket was more, which means they have less money left in reserve. My way, the way that I taught these 40 realtors, is pay full ask. Ask for the incentive, get the lower monthly payment, and keep $8,000 in the bank account. That right there is how we...
But the lower monthly payment option would involve paying down the mortgage insurance up front?
Yes. Yeah, because it's all about leveraging this $20,000 seller credit.
If you pay down the mortgage insurance, do you...
You just buy it out. It's basically one payment up front. I'm using the seller's funds to do it.
But you're like risking, if the market somehow got hot the following year and you gain the 80% equity that you needed in that loan type.
Yeah, you're talking.
You know what I mean? And then now I'm like, well, I paid that up front, and I could have got the PMI removed with the new appraisal.
Yeah.
Is that kind of a downside of that?
Yes.
But that would be rare for the home to appreciate in like a year after you buy.
And you can hate on me all you want.
Okay.
God, cue Nas right now. You can hate me now,
hey,
but I won't stop now.
Nailed it.
Yeah, cue some Nas, bro. The market ain't getting hot.
Yeah.
The market is not getting hot.
Not today.
We're looking at 2-3% appreciation for the foreseeable future, which when you study home appreciation over the past 75 to 100 years, it averages probably 4%, right? That we're in that time frame. The hotness that happened during COVID, no, that happens once every 10 to 15 years.
Every decade, yeah.
Yeah. So, okay, so that's number one.
That's cool.
That's making homeownership more affordable. Okay. Now, I'm going to share some other ways that you can make homeownership more attractive and more attainable, and you can stack all those strategies I just talked about. It's basically using seller credits to make homeownership more affordable.
Yes.
And I'm going to talk about how to make homeownership more like available.
Yeah.
And then just know that when I make it more available, you can stack some affordability things, kind of get a 2-for-1. But I promise you, I do something on reverse mortgages.
Yeah.
Because reverse mortgage is also about kind of affordability.
Okay.
Okay. And I have a particular scenario I'm going to walk you through. And this is what I walked all of these realtors through.
Yep.
But I teased with you, Mike. I said, quit calling it reverse mortgage.
Right.
Okay. Do you know what I'm going to call it, Karina? You're with me a lot. You've heard me say this. You and I created content for Talk Mortgage to me where this came up.
Quiz, pop quiz.
No.
She's like, damn it, quit calling on me.
Yeah.
Yeah, no, I have no idea.
Okay.
Loan officers, if 2026 is going to be your breakout year, this matters. Most originators don't struggle because of rates. They struggle because they don't have systems, structure, or accountability. I'm Coach Christy with TLAP's Originator Coaching. Originator Launch is a 16-week small group coaching program designed to help you build a real business, not just close the next loan. You'll get weekly live coaching, proven scripts used by top producers, real accountability, homework that actually moves the needle, and 2 private one-on-one calls with your coach. This program is capped at just 10 originators, so the attention is personal and the results are real. This isn't a course you watch. It's coaching you execute. If you're ready to stop guessing and start building with intention, apply now. Spots are limited, and once they're gone, enrollment closes. Register today.
I don't like the mortgage industry and how we market. I teach and coach that the issue I have with the mortgage industry and how we market is we speak to our competition. Our competition is other people who understand LTV, DTI, AUS, right? They speak the jargon. Our audience does not. Realtors and home buyers, speak to them like they're in 4th grade. Right? You have to talk about things in a manner of how does it benefit them. How would a reverse mortgage help your abuela or your mom? Your mom's probably too young.
Are you asking?
When you hear the word reverse mortgage, what does the word reverse even mean to you?
Go back.
Go back?
Like,
okay, so what am I going to do? I'm going to go back in time? Like, what are we doing? Are we writing a mortgage backwards? Like, what are we doing? Reverse. Exactly.
I have no idea. It can't be like erased. It wouldn't be erased, but like,
yeah.
I don't know.
What if I told you I had a senior home loan advantage?
That sounds a lot better.
Right? You're a marketing guy.
Yeah.
Hey, wait a minute. I can decipher this. I'm a senior.
Yeah.
Almost. I want a home.
Right.
Bite me. I want a home. I own a home, and I love advantages.
Yeah.
Right, dude. Retired people, they want their discounts.
Yeah.
Right. They want that blue plate special. They want the AARP discount. Yeah. So a reverse mortgage is a mortgage that you don't make a payment on. It is a mortgage that your balance actually grows, and I think that's where the term reverse comes from. Normally, when you have a mortgage, a forward mortgage, you're paying down the principal every month. In a reverse mortgage, your principal is growing every month. Okay. And I think that's where the term reverse comes from.
Okay.
Yeah.
But it's confusing. It's a freaking senior advantage home loan.
It's
right?
like
senior advantage home loan.
It's like a Uno reverse. Like you're like,
That's
hey,
exactly what I was thinking.
Well, you're like, hey, family, you're gonna pay everything after I die.
Yeah.
Okay. By the way, if you're sitting around waiting for your mom or your dad to die,
That's
so
a
you can
problem.
get their house.
That's a problem.
Yeah, go pound sand.
Yeah, that's
Right?
true. You're a bad person.
Like you can do
Karina.
You can do.
No,
Yeah,
I'm
okay.
kidding.
Karina has like 5 siblings. They're gonna be fighting over that
No,
home.
seriously.
That's true.
Yeah. No, but it's like when someone is in a reverse mortgage, yes, their balance goes up. However, you're typically lending at such a low loan to value.
Yeah.
And in the example I'm going to give, it's going to be at 50% loan to value.
Yep.
Okay. Even if that home balance, that principal and interest balance goes up, the market should be going up by 2 or 3% based on the home's value.
Yeah.
Okay. Their balance is going up a little bit based on their loan amount, right? So one's at, let's say, a $400,000 starting point. One's at a $200,000 starting point. And when the person moves on, either whether they move on from life or they move on from the home, and they go to sell the property, 99 times out of 100, there is equity. Do you know the one time there wasn't equity? The one time.
The Great Depression.
The Great Recession.
A Great Recession.
Yes, when none of us had equity.
Yeah.
The same time that I owned a home that was once worth $250, I owed $230.
Yeah.
And I woke up 9 months later as if my name was Rip Van Winkle and my home was worth $130, but I still owed $230.
Yeah.
Yeah, that time period in life. We call that time period 08, 09.
Yeah, I was going to say 2009. Okay.
Yes,
Yeah.
like that was the one time. Other than that, when reverse mortgages are done and the person passes on or they move into the retirement home and the family has to sell, there is still equity there.
Yeah.
Okay, so they're not a terrible thing, but that's not what this episode's about. This episode's about affordability.
Right.
Here's an exact scenario that I recently had happen. And it was someone that I knew personally, and I put him in contact with one of my LO friends, and she helped him out. They were selling a home in New Hampshire. It was their primary home. They were both retiring, and they both were getting pensions. Pension, very small Social Security. Okay.
Yep.
Sold their home in New Hampshire. They netted $300,000. Real story. They were like, "Oh, we don't have a mortgage. We paid our mortgage off years ago." They were so proud. They had a $75,000 home equity line of credit that they had used for a new roof and some solar panels and some other things.
Yeah.
That they thought they were actually going to net about $350 from the sale of their home.
Is that 275?
Yeah, they got like right around 300.
Yeah.
Right. And it's like, look, yes, they paid their mortgage off years ago, but they got a home equity line. That's just a little sidebar.
Yeah.
But they sold their home in New Hampshire and they had $300,000 to buy the home in Fort Myers. Actually, they're going to buy down Fort Myers, Florida.
Okay.
That was their dream. I love it down in Fort Myers, Southwest Florida. It's gorgeous.
Yeah.
down
Yeah.
there, right.
Agreed.
So they start looking. Well, they can't find anything for $300,000.
Right.
If they do, it needs some TLC. It needs new paint. It needs a new roof. It needs new landscaping. The bathroom's outdated.
It's not turnkey. It's not going to be turnkey.
Yeah, and these people are in their mid to late 60s.
Yeah.
Like this is not what they're looking to do. If they wanted to find other homes at $300,000, it's a 40-minute drive to the beach, a 20-minute drive to the golf course. Not what they envisioned.
Right.
They're frustrated. And oh, by the way, like their daughter's down in Sarasota, so they kind of liked being down in Florida so they could see their grandkids more often.
Yeah.
So it wasn't going to work. And he was handling it well. She wasn't. The wife wasn't. So I just suggested, have you ever thought about a reverse mortgage? I'm like, well, that's for the home that we already own. I said, no, you can buy a home using a reverse mortgage. Let me walk you through the math. And I walked them through how they could buy a $400,000 house. Because for $400,000, they could get the location and the quality of home that they were looking for. Like
more turnkey.
newer home, more turnkey, in the right location.
Got it.
But they didn't want a mortgage payment because they could have just put, look, $300,000 down, financed $100,000, made a payment of roughly $600 principal and interest, called it a day. But their budget didn't really allow for that. That was going to be a cramp in their lifestyle. I said, then hear me out. Go buy a $400,000 house. Use a reverse mortgage to buy it. Put $200,000 down of your $300,000 and never have to make a mortgage payment. Like, I can do that? I'm like, yes, you can do that. Like, yeah, but aren't the closing costs expensive on a reverse mortgage? Like, yeah, I'm not going to lie to you. They're a little bit more expensive than a forward mortgage. I go, but negotiate with the seller. Get a seller credit. So they negotiate a 4% seller credit. Seller pays all their closing costs. They buy the home for $400,000. They put $200,000 down. They started with $300,000. So how much money's left over? Karina? There we go. You're dominating some quick math with me. I'm going to turn you into a loan officer one day.
No,
Yes.
By the time you turn 30, you're going to be slinging loans.
I'll be
girl.
like, yeah, show me your NMLS number, girl.
Yes, look at her. Presentable, attractive,
-2.
bilingual.
Yes.
Right? I'm going to get you from behind the camera in front of the camera. We're going to get her doing some TikTok lives.
Yes.
Generating some leads.
Yeah, we were just talking about that.
Yeah, you'll be the queen of St. Cloud and Kissimmee. You'll be crushing it. Making
gosh.
$25,000-$30,000 a month. Life changing.
No, stop. We need her here. Cut it
Okay.
out.
Yeah, he's like, that's
Cut it out.
All right. So yes, the answer is you have $100,000 left.
Yeah.
Well, then I put them in contact with my buddy over at Northwestern Mutual. He's a financial advisor. He takes that $100,000, he puts into an investment account. He now is spitting out $350 a month in additional income.
Nice.
So they're getting their pensions, they're getting their small Social Security. They live in the home that they've always dreamt of. They don't have a payment. And they're collecting an extra $350 a month.
Solid.
Yes. Like I just made a situation where they're like homeownership's not available and it's not affordable to now it's available and it's affordable. And oh, by the way, they have an extra $350 a month. That's $350 a month they can spend on their grandkids. That's $350 a month they can spend on not having to buy generic medicine.
And like what you said, the realtors aren't necessarily aware of this. Like I have to agree with you on that. Like they're my clients as well. And maybe if you're the broker, like, but
no, home builders aren't. Financial advisors are not.
This is good.
It's our job to be teaching this type of stuff. So, okay, so those are the 2 things, 2 of the 5 that I taught.
Yep.
Here are the other 3, and I won't go into as much detail just for time's sake. But the second thing that I talked about was using a renovation loan to create the inventory you desire. And I'm going to give you case in point. And I'm going to use for our Central Floridians.
Okay.
Seminole County is a county that's the second smallest county, I think, in Florida. But it's known for its A-rated schools. So a lot of people want to live in Seminole County because of the public school system. However, with it being a small county, it's also a landlocked county. It doesn't have that much available land. So a lot of the homes are older. Like I think about the neighborhood that I grew up in. It's a starter neighborhood. I mean, my mom, the school bus driver, my dad, the electrician, couldn't afford to own a home in Orlando back in 1976. So they moved all the way up north into this new county back then so they could afford a home. And it was an 1,100 square foot block home, 3-bedroom, 2-bath, that they raised my sister and I in. Like all 1,100 square feet. It was perfect for us. Well, that home today was built in 1976. That roof may be from 1996. That AC may be from 1988. That yard is more weeds than it is grass.
It needs some work.
But I'm going to promise you this. The elementary school, the middle school, and the high school are all good public schools. And when you go to buy that house, you're going to look at the sales price and you're like, they want $300 for that? Like, I can't. $300,000? Okay. Slow down. Most people would walk. They'd be like, look, I'm looking for $300. That's the home. I don't want it. What if I could show you how to get that home for $300, have the seller pay all your closing costs, just like I did in that first example. All your closing costs, buy down your interest rate, like really make it attractive. Because you're going to finance $375,000. That extra $75,000 is going to add roughly $450 a month to your monthly payment. However, with 3.5% down, the seller's going to pay all your closing costs, and the seller's going to drop your rate from 6.5% all the way down to 5%. So that's going to wipe out most of that $450 a month that was going to come because of the extra $75,000. We're using a seller credit to keep the payment in line to where you're comfortable. You're not having to pay your own closing costs. All you need is your 3.5% down. And then the bank, because you're doing a renovation loan, is going to give you $75,000. That's a new yard. That's a new roof. That's a new AC. That's new floors. That's new paint. That's a brand new kitchen, brand new master bath, and brand new guest bath.
Do you have to do like a DSCR for this, or
no? It's an FHA loan. It's a 30-year fixed FHA loan with 3.5% down.
That's awesome.
You can do a conventional loan with 5% down. Right. Conventional is called home style, and a FHA loan's a 203K. Okay. That's the loan that you're doing. But it's how you market it and position it. Like I coach those realtors, like, look, don't call it a renovation loan. Don't call it an FHA 203K or a home style loan. Nobody knows what that means except for insiders. But market it and advertise it as kind of like that. You can have your cake and eat it too. We buy real estate based on location. We then customize to our liking. So this is a own the home based on the location you want to be in, and then customize the home by using this special financing. And then you have to walk them through how to pay full list, negotiate with the seller to cover all your closing costs and then some, while doing a renovation loan that lets you finance in all these repairs. Now all of a sudden, your kids can go to the schools you want to go to. Your drive to and from work is what you want. You have a Publix or a supermarket within a mile, not within 10 miles. And this home that's in a cute neighborhood, but the home's a little bit older and it's not taken care of, all of a sudden, after 60, 90 days, your contractor leaves and it looks like it's brand new, just happens to be built on an older frame. Right? So that's a way that we're making homeownership more attainable, more attractive, and really you're kind of creating the inventory that you desire. So we stuck on that topic of creating.
Creative.
It is creative, And it's nothing new about it. Like I was doing FHA 203K loans back in 2006.
Yeah.
They're a pain in the ass, by the way. Not going to lie. Like there's some people do them really well. Like our dude,
Like they're a pain in the ass to get through underwriting type of thing, like you're saying, or
they're a pain in the ass.
they're
Like,
just a pain in the ass.
yeah, like you have to go get contractors involved, and
Yeah.
you have to get scopes of work,
Yeah,
and you
yeah,
have
I
to
got
get
you.
bids, and it's more work.
Yeah.
If you're a licensed originator who's closing loans, but you're not consistent, this is for you. If you're brand new or just looking for motivation, trust me, this is not for you. Most LOs don't need more information. They need structure. They need proven processes and somebody to hold them accountable. T-Lob's Originator Coaching gives you weekly live coaching, scripts top producers actually use, and step-by-step business systems you can implement immediately. Not someday, we're talking day one. You're not watching videos alone. You're executing in real time with other originators who take this seriously. Right now, you can try it free for 2 weeks. That's 2 full weeks for free. You'll sit in on live coaching calls. You'll get access to the frameworks and see exactly how top producers run their business. If it creates clarity, if it creates momentum, or even if it puts wins on the board, you keep going. If it doesn't, no worries, you can cancel. No pressure at all. Click the link, start the 2-week trial, and finally, build this like a business, not a side hustle.
Right, but it's like anything in life. I mean, you want something bad enough, you work for it. Right, but like we've had Joe Manglardi on this show.
Yeah.
Joe's a 203K expert. There's this guy with CMG Home Loans, Jamie Zietz. Jamie's a 203K expert.
Yeah.
So there's plenty of people in this industry that have really crushed it with 203Ks. But no, we stayed on that same topic of 203K. Now I'm thinking about, well, if I stayed on that same topic, how do I go create the inventory I desire? Because I'm a home buyer, I'm getting frustrated. There's not enough inventory, or the inventory that's available, it's
Not meeting the criteria.
It's not meeting my criteria.
Yeah.
Cool. You know what you can go do? Go find a lot, get with a custom home builder, build your own home.
Yeah.
Right. There's VA
go.
construction lending, 0% down for qualified veterans or active duty military.
Nice.
There's FHA construction with 3.5% down. There's conventional construction loans with 5% down.
Those harder to qualify for, not the VA one, but the other two are they
In
harder
general,
to qualify
it's like,
for?
it's like anything. When you start layering risk,
Yeah.
then yes, like you have to get the builder approved. You probably can't self-build in many instances. And yes, you have to find a lot. And if you don't have the ability to use a lot loan to purchase the lot or buy the lot outright, then you have to work with the builder to have the builder put the lot under contract.
Yeah.
And then you can come in and actually buy the lot from the builder while also closing on the construction loan all at the same time. But I was teaching these realtors how to market and advertise to their database. Hey, look, if you are wanting to purchase a home, but you're tired of seeing the same old tired inventory, please know there are other solutions. Reach out to me and I'll talk to you about how you can create the inventory you desire, how you can build your custom home with as little as 3.5 to 5% down.
Yeah.
And oh, by the way, it's kind of like I feel like, oh, wait, there's more.
Yeah.
But wait, there's more. All of those same strategies of negotiating in a seller credit to offset closing costs, to buy down your interest rate, to buy out your mortgage insurance, all of that can still be stacked with a construction loan.
Yeah. So
Right? There is a way to have your cake and eat it too. You just have to think a little bit bigger. You have to get more creative. Don't just sit back and wait for things to be handed to you. Go out and advocate for what you want. So then the last thing was like understanding the leverage of ADUs and multi-unit. Hey, you know what? You maybe can't afford a single family home. You just can't. But you could afford a duplex. You could afford a triplex. You could afford a quadruplex. Right? Karina may be looking at me like, Dio, I can't afford a home. Like I'm a single professional. Right? I make what I make, but I'd say, well, what if we found you a quadruplex? Right? What if we found you a 4-unit place, right up in Deltona, where you could live in one unit, 2-bedroom, 2-bath. You could rent out the other 3 units, 2-bedroom, 2-bath. You could buy it with as little as 3.5% down and have the seller pay all your closing costs.
Well, you said now they're not looking at that you don't have to have that lease in place for a year before they got more lenient with that.
Like guidelines change every
That's
single day.
cool.
But like you can leverage proposed rent on ADUs.
Yeah.
Which an ADU would be like I'm buying a single family home, but it has like a detached apartment or it has like a over the garage apartment.
We have that, yeah.
Yeah, right. So like you can use that, you can rent it out, and you can use the proposed rent to offset the mortgage payment.
Yep.
You can do the same thing with a with a 2-unit, which is a duplex, a 3-unit, which is a triplex, or a 4-unit, which is a quadruplex.
Up to 4 units.
Yeah, up to 4 units. You get over 5 units, it's a commercial.
It's a commercial, yeah.
Yeah, but it's like that's what certain home buyers have to look at.
Yeah.
And in certain markets, multi-unit are less available than other markets. But I know where Karina lives, if she wanted to stay there, right now, if you want to move downtown, you may be looking for a duplex, right? But would you not want to live in a duplex where, yes, you dropped $600,000 on this thing? Maybe your budget was only $300,000, but at $600,000, you could rent out one half, live in one half. Now all of a sudden, you own a $600,000 property, but it's only costing you roughly $2,000 a month.
Mm-hmm.
You're renting the other side for $2,000 a month.
Yeah.
Now your mortgage payment on that may be $4,000 a month.
Right.
Right. So like you have to understand that's your mortgage payment. And then let's say you were able to, between whatever money that you pulled from retirement funds, your own savings account, maybe a gift from your abuela, like you're able to put together the down payment, you negotiate the sale to pay your closing costs, and now you have those reserve funds.
Yep.
Right? Because when
Excellent.
you're buying a multi-unit, it could be a little bit unnerving, being like, "Whoa, wait a minute. What if I don't rent one of these units?"
Mm-hmm.
So maybe you want to have more reserve assets. So in essence, the 5 ways that we were teaching, we first started with leveraging seller credits. We then talked about using multi-unit, whether it's a place with an ADU or a 2, 3, or 4 unit. We then talked about how to leverage renovation lending to go out and create the inventory that you desire using older homes, but making them more beautiful, more modern, more up to the code, up to speed.
Yep.
We then talked about how you can just go out and build the home that you desire. And then finally, we ended the presentation with talking to our retirees about how they can leverage some financing solutions to make affordability and homeownership more possible. So loan officers, you should be teaching this to realtors. You should be creating content to educate the communities that you serve.
Yep.
Realtors, you should be making content, and your marketing needs to speak to these people as if they're in 4th grade. Don't use industry jargon. Talk about the pain that you solve. And then obviously, if you ever have any questions, like, look, if you're listening on YouTube, I guess you should be watching on YouTube. You can comment below, and we can get some dialogue flowing. If you're tuned in on Spotify or Apple, I'll first say thank you. Make sure you give us a 5-star review. Your 5-star review is what introduces more people to this content. But you know that you're missing out by not being subscribed to our YouTube channel, A, because you can't comment, but B, because we have 400 other pieces of content that aren't podcasts that you're missing out on. It could be Talk Mortgage to Me. It could be the DO Show. It could be Mortgage School. It could be Coach's Corner. Make sure you go to our YouTube channel and you click subscribe. But Karina, Mike, any parting shots for the audience? Anything that we missed?
No, it's solid. I think the point is equipping the realtor with enough knowledge on these 5 items that you just said, so that if they do have a buyer that they cross paths with that does have a unique situation, right, and they have to get creative, they can at least talk intelligently about it and then say, hey, by the way, let me actually hook you up with my boy Dustin Owen. He's my mortgage guy. He's excellent. You're gonna love him. And then they pass the lead your way.
Correct.
So I think it's excellent. It's a great
Karina,
strategy.
You've heard me say this. When I talk to loan officers and realtors, it's their job to, do you know this one yet? Oh,
no.
God, she's got scared again. Oh, my God,
their
the
job
teacher's
to-
calling on me.
Find leads or something?
Yes, it's your job to get a lead.
Boom.
Okay, I
It's
got
your
it.
job to
go.
get a lead. That's it. Our job is to talk to one person a day that needs or wants a home loan.
Yes.
It's realtor's job every day to talk to one person who wants to buy or sell real estate.
Yep.
Okay, these are all conversation starters. I'm not saying you're going to use a 2 or 3K loan. I'm not saying that this person's going to want to build their own home. I'm not saying they're going to need a senior home loan advantage, right? What I'm saying is that you're trying to create and market your way in a sense that people want to reach out to you and have a conversation.
Yeah.
From that conversation, you can decide what they need. You may have been talking about an FHA 203K, but really they needed a HOPR loan. You may have been talking about building their own house, but you realized that the best move was to use your state down payment assistance loan. But what you did by creating conversations is you created engagement. Engagement means you talk to one person a day that needs your service or wants your product.
Absolutely.
Cool.
Yep.
Hey, mortgage loan officers, we're dead serious. If you want to be a part of the coolest mortgage event, you got to check out our TLOP event, Caribbean Takeover, September 14th through 18th. And then lastly, if you're looking for coaching, you need coaching, you're ready to better yourself, you want to invest in your future success, go to our website, tloponline.com, and figure out how we can invest in your future success. She's the producer extraordinaire, Karina Mojica. He's Marketing Mike. I'm Dustin Owen. You've just tuned in to the Loan Officer Podcast. That's all the time we have for you today, but we do look forward to catching you on our next episode. Peace.